Welcome back, everyone. In my previous 9 a.m. video, we covered the basics of 9 a.m. CRT model, and I am glad to see the incredible interest and questions from all of you. Today, we are taking it a step further. I will break down every detail of that CRT model so you can master it with confidence. This model has the potential to completely transform your trading career, allowing you to trade with more precision and consistency. If you have been dreaming of leaving your 9-to-5 job behind, this could be the game changer you have been waiting for. So stay tuned, because this is where you start taking control of your financial freedom. So without wasting any time, let's get right into the lecture. These are some key points in the 9 a.m. CRT model that we will be looking at in detail. DOL, draw on liquidity. This is the most crucial element. Without understanding the concept of draw on liquidity, or knowing the direction in which price is likely to move, you can't align yourself with the market effectively, nor execute trades with confidence. Key level. Identifying key levels is another important factor. It enhances your setups and increases the probability of winning trades. Lower time frame CRT. This serves as an excellent confirmation tool, helping you stay on the right side of the market and improving your win rate. Entry models. Learning the strategies and predicting the price move is straightforward, but executing it live is very challenging. This is where psychological factors come into play. To become a successful trader, you need a solid, strong, and reliable entry model. Let's dive into each of these components in detail to understand how they can strengthen your trading approach. Draw on liquidity is a key factor that establishes your market bias and narrative. Understanding draw on liquidity helps you determine which direction the price is likely to move, allowing you to align yourself with the market and trade with confidence. In this section, we will learn how to accurately identify draw in liquidity like a successful trader. The first step is to align yourself with institutional order flow. You have probably heard the saying, "The trend is your friend." To identify the direction of institutional order flow, you need to observe how price reacts to certain levels and structures. In a bullish institutional order flow, price consistently breaks previous highs and rejects lows, respecting bullish PD arrays such as order blocks, imbalances, and breakers. In a bearish institutional order flow, the opposite happens. Price breaks lows, rejects highs, and respects bearish PD arrays. Aligning with institutional order flow ensures that you're following the market's momentum rather than fighting it. Once you have aligned with the institutional order flow, you can build a strong market bias. A key technique to confirm bullish or bearish bias is candle structure. A wick below indicates bullish sentiment, while a close above a key level also signals bullish strength. For example, if a candle, whether on the daily, weekly, 4-hour, or 1-hour time frame, wicks below the previous candle but closes within the range, you can expect the next candle to be bullish. Similarly, if the current candle closes above the high of the previous candle's body, you can anticipate bullish movement in the following candle. The same concept applies in reverse for a bearish bias. Avoid trading during ranging or consolidation phases. When the market is in consolidation, it lacks clear direction, which makes finding reliable setups more challenging. Waiting for a clear directional move will increase the probability of a successful trade and help you stay aligned with the order flow. By mastering these aspects of draw on liquidity, you will be better equipped to read the market, align with the institutional bias, and make confident, calculated trades. Key levels play a crucial role in increasing your winning ratio when trading with the CRT models. Identifying strong key levels makes your setups more high probability and reliable. To identify important key levels, focus on such as order blocks, breakers, imbalances, fair value gaps, and old highs and lows. These levels often serve as points of interest where price reacts, providing you with potential entry points. But how do you determine which key levels are likely to hold and which might fail? This is where dealing ranges come into play. A dealing range is plotted between a swing high and swing low. Here's how it works. Start by marking a clear swing high and swing low on the chart. The range between these points forms your dealing range. The dealing range can be divided into zones. Everything above the 50% midpoint is considered the premium zone, while everything below it is the discount zone. This midpoint itself is called the equilibrium. When looking for key levels, focus on finding them within these zones. In the premium zone, look for sell opportunities, as price is considered overvalued here. In the discount zone, look for buy opportunities, as price is considered undervalued. By focusing on these levels within the appropriate zones, you align yourself with high probability trades. This approach not only increases your success rate, but also helps you stay disciplined, avoiding trades in less favorable areas of the chart. Mastering key levels and using dealing ranges effectively will greatly enhance your CRT trading models, allowing you to approach the market with precision and confidence. The lower time frame CRT is a crucial element that provides precision in identifying trade entries within the larger framework of the CRT model. Many of you have questions about how to correctly identify and mark the lower time frame CRT, so let's break down the criteria clearly. First, you have wait for the 8 a.m. hourly candle to close. Once it closes, mark the high and low of this 8 a.m. candle as a CRT range. Next, switch to the 15-minute time frame and monitor for a sweep of either the high or low of the 8 a.m. range. Here's what to look for. Once the high or low of the 8 a.m. candle is swept, look for a 15-minute candle that sweeps the high or low of the previous 15-minute candle and closes back inside the range. This specific 15-minute candle is what you'll mark as the lower time frame CRT. This 15-minute candle can sometimes sweep both the high-low of the 8 a.m. candle and the previous 15-minute candle in one move. Alternatively, multiple candles might be involved, where it takes 2 or more 15-minute candles to meet this criteria. For example, as you can see here, this black 15-minute candle has swept both the low of the previous 15-minute candle and the 8 a.m. low simultaneously, closing back inside. And this candle qualifies as our lower time frame CRT, and you will look to take your trade on the third candle below or above its opening price, depending on your bias. By marking this 15-minute CRT candle, you refine your entry within the broader 8 a.m. range, allowing for more precise trade decisions. This approach ensures that your entry aligns with the institutional flow, enhancing both accuracy and probability. The final and most critical element of the CRT model is execution. Here, we will study 4 solid entry models that are essential for precise trade execution. Order block. After one side of the CRT range is purged, switch to a lower time frame and observe the last thick down close candle. When price closes above this candle, it signals a change in the state of delivery, and this last down close candle becomes your order block. This order block now serves as a point of entry, aligning with the new directional bias and vice versa for the bearish scenario. Breaker. A breaker is formed when price closes above an old order block from a previous price move. This indicates a shift in momentum. In bullish conditions, the last up-close candle before the price breaks, a previous high becomes the breaker, and the opposite applies in a bearish conditions. For example, if you see a low, high, lower low, and then price breaks above this high, the last up-close candle in this sequence forms the breaker. OTE, optimal trade entry. For those familiar with ICT, OTE entry is a well-known strategy. Without going into too much detail here, OTE can be used to pinpoint optimal retracement levels, allowing for highly precise entries. Kiss of death, KOD. The KOD entry occurs during a final purge before price hits a higher time frame target. This entry is characterized by a sudden sweep of liquidity, making it a valuable setup in anticipating a strong directional move. Now, let's move over to the live charts and examine how the 9 a.m. CRT model works in real market conditions. So we are on the S&P 500 daily chart, and we are clearly in a bullish institutional order flow. As you can see, prices are consistently breaking highs and rejecting lows. Here, price has recently swept this old low and give a reaction. So this is our key level, which is an old low. Now pause the video and tell me what you see besides this. For those who didn't pause the video, you are doing wrong yourself. Alright, let me clarify. Price swept the low of this thick down close candle after hitting a key level, and this is an inside bar candle. So, we mark this candle's high and low as the daily CRT range. And since it closed inside, we'll expect a bullish day, and our draw on liquidity will be this candle's high, as it's our daily CRT. Next, we switch to the 1-hour time frame and try to trade the 9 a.m. model. Here, you can clearly see price created a market maker buy model, and this as an original consolidation. But I won't go too deep into it, otherwise we will stray from the main topic. So we set a vertical line at the 8 a.m. time window and wait for the 8 a.m. candle to print. Let's see how it plays out next. Alright, the 8 a.m. candle has closed, so let's zoom in for a clear view. Okay, the 8 a.m. candle has closed, so we mark its high and low. As you notice, the 8 a.m. candle is an inside bar, so we will mark the high and low of the previous candle as the CRT range. We have marked the high and low, and now we switch to the 15-minute time frame and look for a lower time frame CRT. Alright, we are on the 15-minute time frame now, and we will wait for the 8 a.m. candle's high or low to be swept, and for a lower time frame CRT to form, and to decide our next move. Let's see what happens next. Alright guys, you can see this 15-minute candle not only swept the low of the previous 15-minute candle, but also the low of the 8 a.m. candle. So this black candle will be our lower time frame CRT because this candle closed inside it. Let's mark its high and low. And from the opening of the next 15-minute candle below, we can open a long position. Next, we switch to the 1-minute time frame for the entry model. If we get confirmation, we will open a long position. We are now on the 1-minute time frame, and you can see price has closed above this last thick down close candle, which is our high probability order block. We will mark it, and if price retraces back to this order block, we will open a long trade, placing our stop below this swing low, and our target will be the opposing end of the 8 a.m. candle. Let's see how it plays out. Alright, price has tapped into our order block, so we open the trade here. Let's see how it goes. And boom, our target is hit. Next, we switch to the 15-minute time frame and hold our trade up to the daily CRT high. Let's see how it plays. Alright guys, you can see our final target has been hit. Here you can also see my live execution. I won't add further examples, and I'll make a backtesting video on it. So if you want me to make a detailed backtesting video, let me know in the comments. For more trading insights and information, join the Telegram channel and follow on Twitter. Good luck traders, and see you in the next one.